Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
For the moment, markets are, actually static, almost grounded at where they closed yesterday. So that gives us a good time to mull over more medium-term issues with our market master, S. Krishna Kumar, CIO Equities at Sundaram Mutual Fund, has joined us. Good morning, Krishna. Thank you very much for joining us. And here's wishing you first and foremost a happy 2018. How would you go into the budget? Do you think that it's going to make a material difference at all to the markets? Or will it be just, some seesaw before, but the longer term trend continues?
Yeah, I think clearly in the last year of this term, the government would more or less try to consolidate on all the major steps they've taken, rather than trying to open up any new front at this point in time. So we don't expect any big bang reforms further at this point in time, but rather steps to progress many of the things that they have been doing in the last 3 to 4 years, and ensure that there is a broad feel-good that is there in the economy as we run into the elections in the next 12 months. So I think that should be the way forward, and so the budget would be more or less a budget which is not going to be not going to be doing anything aggressive, but staying on course in terms of fiscal, trying to allocate again towards a lot of schemes on the rural development side and towards job generation, etc., which would be very important in the next 12 months for the government. Also, I think in terms of the benefits of the reforms, I think the taxpayers, both corporates and individuals, need some breaks. So there would be probably some kind of giveaway there to get a feel good. So it should be a moderately okay budget which should pass through. Nothing significant to alter the course of the economy or the market at this point in time.
No, I was going to ask you a little more in detail about this rural focus. With the Gujarat election behind and the general election ahead, this farm focus is something people are talking about. Would you load up on any stock on expectations of a pro-farm, not just budget, but a pro-farm year?
Yeah. See, I think if you look at our portfolios over the last 2 years, and particularly, we have a fund which is focused on the rural development theme, which is the Sundaram Rural India Fund. So broadly, as a fund house, we have been allocating higher towards the rural theme, be it agrochemicals, fertilizers, tractors, etc., and also towards some of the beneficiaries on the value-added parts on the food side, and the other agro-commodities like sugar, tea, etc. So we've been kind of broadly playing the story for the last couple of years, and so at this point in time, we are adequately well positioned on this theme across all the funds, and definitely, we believe the next 1 year the financial inclusion will further percolate post the DeMon and the GST disruption. Okay. So I think on the rural financial services, I think that could be some good place.
Okay. Okay. Krishna, good morning. We can discuss individual sectors as well, but I just wanted to address the larger theme. Your two mid-cap funds, the Select Mid-Cap and Smile Fund, have given 40 to 45% annualized returns over the last 3 years. So I'm sure investor expectations are high. You've seen the highest ever inflows into mutual funds. But is this sustainable? Markets have done well, and bottom-up stock pickers have done well. But as a fund, do you think this kind of performance is sustainable?
Yeah, you asked two questions. One is in terms of inflows and second in terms of performance. So I think as we have been discussing in the last 1 or 2 months, return expectations should moderate at this point in time from the hefty 25, 30, 40% that we are seeing. We need to get a little bit more real because valuations are factoring in a lot of the positives that we have been talking about for the last 2-3 years. Earnings are catching up a little slow at this point in time, but we believe that from this quarter onwards, we should be into mid-teens kind of earnings growth and accelerate into the next 2 years. India will regain its position as the fastest growing economy and will accelerate further over the next couple of years. So we don't, see any major, threats to the economy doing well and the markets continue to reflect the positiveness. However, I think the returns would be more moderated to that 15-20% CAGR going forward, and that's what investors should look at. And that's the message that we are kind of giving out in our meetings. Also, in terms of inflows, I think clearly, if you look at alternative, investment avenues, I think still equities do stand out well from a return perspective on a post-tax basis, and we do believe that that would ensure that money flows into markets would continue. Also, it's also important to see that the financial savings rate itself will go up in the country as people shift away from physical, given the inflation levels that have tended to lower levels on a decadal basis. So I think that could be a more structural shift that you will see in terms of more financial savings vis-a-vis physical savings. That will go through over the next many years, and a shift in terms of stock also would happen, and that would be a major driver for markets and financials.
Okay. By the way, there's an alert that Bitcoin has slipped in trade. It's down about 11%. Not just us, but Warren Buffett warned you as well. He said that this cryptocurrency trade will come to a very bad end. So when an influential investor like Warren Buffett warns you, that's what perhaps happens. Krishna, good morning. I wanted to talk about some stocks as well, because a space that you've invested in and made big returns in is the cement space. So in your funds, you do have names like Ramco Cement, JK, Heidelberg, etc. And this quarter is expected to be good. I mean, decent volume growth of 10%, etc. Is this a space that you could see incremental buying interest over the next couple of quarters?
See, clearly, if you look at the government's thrust on infra, there's been a huge amount of pickup in the last 2 years, and the order books of EPC construction companies are swelling at this point in time, and you'd be surprised when the numbers come out in this quarter in terms of order books, etc. And also the affordable housing schemes of various central government and the state governments are really picking up steam at this point in time, and all this together would ensure that there's a positive rub-off on a cement sector, basically. I think after the kind of weak growth the last 2 to 3 years, there's a good pickup at this point in time in terms of double-digit growth. So we do see that the pickup will sustain strongly, and already you're seeing cement companies starting to invest into new capacities, anticipating the growth over the next 5 years. So that's a very positive sign. Unless people expect long-term growth to revive, cement companies will not really add capacities to the already huge capacity that they have when the utilization level is So clearly, I think we are in for a very strong performance from the cement sector. Costs are broadly under control, and the margins should slowly expand as utilization levels get better. So we remain very positive on the cement space, particularly on the South cement side, where the recovery could be far sharper given the 5-6 years of slowdown that we've had from 2011 to 16.
Okay, Krishna, we are going to see a lot of sectors give us probably 50-70% growth simply because of the demand base. Cement could be one of them, but there will always also be two-wheelers. We've already seen that in the monthly numbers. But how much is in the price? At what point will you be moved to saying that the earnings are better than expected? If the overall earnings growth is more than 15%, will that be better than expected? Does it have to be 20% for it to be better than expected?
I think different sectors have different bases, and hence growth rates could be different. But broadly, I think investors have penned in a 12 to 15% earnings growth in this quarter, and a little higher in the fourth quarter, and going forward between 15 to 17% on the broad markets. So that's a broad expectation, and anything above this definitely would be positive. But as I mentioned, the PE multiples are where they are at about 17-18 times, and hence one would probably just try and play, the earnings growth, which will drive returns at this point in time. So So what we are looking at is probably looking at a very well diversified portfolio at this point in time, because various sectors have started to do well. It's not A versus B, but I think it's more important that we get the stock selection right at this point in time to get the surprise element into the portfolios, basically.
Okay, there are two new trends, if you please, in the last 3-4 months. One is the rising crude prices, and the other is, because of that, the rising bond yields. How has that altered your stock selection?
Our view still remains that the crude prices will soften into the next 1 month, back to about $60. So that's one of the bases, and so we believe that crude-driven inflation, is more going to be seasonal and will come back down. The other parts of the CPI in terms of vegetables, fruits, etc., again tend to be more seasonal. So while a 5% plus print is definitely something we see in the next 1 or 2 months, but we don't see that sustaining at above 5.5%. But we would rather be penning in about 4.5% kind of inflation into the next 6 to 8 months on an average. So we believe that overall still yields would be range bound but very volatile within the 30 bips kind of range that we are in. So we would actually wait a little bit to take further view in terms of whether yields strengthen further from here, depending upon the budget, if they really go for a major fiscal expansion, or if we see surprisingly crude breakout above 70, etc. So then we will like to review the call. But at this point in time, we still believe that rates are going to be more range bound at this point in time. The slightly upward bias that we are seeing at this point in time. So nothing significant to worry. But from a portfolio perspective, as I mentioned last time, we have already shifted a lot away from the NBFCs and got into other more secular growth stories outside the NBFCs.
Okay. By the way, this theme today in the mid caps, the strong stock. I mean, after the initial sort of downtake being absorbed, strong stocks are doing well. Just pull out the intraday chart of PC Jewelers. That stock has hit a fresh high, and it's been one of the strongest stocks. And just look at that, once again moving higher and making a fresh all-time high in trade.
Why aren't you saying Aban Offshore again?
Aban Offshore?
I mean, that crude theme is, and as Ashwini was saying, under-owned.
Yes,
so it's climbing every day, 6 to 16%.
Aban's high was 5,500, in 2008. Of course, that was a time when it was a completely different stock and, had a lot of strength. But, of course, since then, things have changed, but maybe priced in the bottom.
You're spotting HOEC is also up.
HOEC has been, that's been a stronger stock, of course, even stronger than Aban over the last 6 months or so. That's also doing well. But Krishna, thoughts on auto and auto ancillaries? Again, a lot of these stocks have done well, and a lot of stocks are in your portfolio as well.
Yeah, we continue to remain positive on this space, definitely. While there will be some consolidation in terms of stocks, basically around different levels, given the performance, strong performance. But I think from a medium-term perspective, I think these have a lot of strength in terms of business models and opportunity to continue to grow at 15-20% top line for a fairly long period of time, and also benefit from operating leverage that they are enjoying, and also become part of global supply chains of various majors. So clearly the auto and auto ancillary industry particularly has come of age, and they become serious players in the global value chain too. So you already have seen many of the players, just to take name, Motherson, Bharat Forge, etc., very strong in the supply chains basically, and we Sundaram Fasteners and many others from the TVS group also have become fairly entrenched globally also. So we see one more wave of players basically which will become as big and as strong as the names we mentioned in the next 3 to 5 years, and that's what we kind of are playing on at this point in time.
All right, Krishna, we leave it at that. Thanks so much for joining us.